In the grand chronicle of financial legends, we often focus on the singular genius, the iconic frontman whose name becomes synonymous with success. For Berkshire Hathaway, that name is Warren Buffett. But behind the Oracle of Omaha has always stood another mind, a partner whose intellectual rigor and profound multidisciplinary wisdom were the architectural blueprint for Berkshire's entire philosophy. That man is Charlie Munger. To understand Munger is to understand that the secret to great investing is not a better financial formula, but a superior thinking process. While others were studying balance sheets, Munger was studying human nature. While others were looking for the next hot stock, he was searching for the timeless causes of human folly. This is not the story of a stock-picking system in the traditional sense. It is a deep dive into the mind of a worldly wise man who believed that the key to long-term wealth compounding was not to be more brilliant than everyone else, but to be consistently less stupid. He developed a set of core principles, an intellectual toolkit for making rational decisions in an irrational world. This is a masterclass on that thinking system. In this first part, we will deconstruct the three foundational principles that form his entire worldview: the latticework of mental models, the art of inversion, and the mastery of human psychology. These are the tools he used to design his mind for wealth. To understand the origins of his unique approach, one must look at his unconventional path. Charlie Munger was born in Omaha, Nebraska, the same hometown as his future partner, but their paths would not cross for decades. His early life was shaped by discipline and a voracious appetite for knowledge. He briefly studied mathematics before leaving to serve as a meteorologist in the U.S. Army Air Corps during World War II. This early experience was formative. Meteorology is a science of probabilities and complex interacting systems, a field that demands a multidisciplinary understanding of physics, geography, and data analysis. It was a perfect, if unintentional, training ground for a future investor. After the war, despite having no undergraduate degree, he was admitted to Harvard Law School, where he graduated with high honors. He went on to found his own successful law firm before realizing that his true passion and talent lay in the world of capital allocation. He started his own investment partnership in the early 1960s and, applying his own developing principles, achieved a spectacular track record that rivaled even Warren Buffett's. It was only after this period of independent success that the two men's paths fully converged, and Munger eventually joined Buffett to become the vice chairman of Berkshire Hathaway. This background is critical because it establishes Munger not as a subordinate, but as an independent genius in his own right, a man who had already proven the power of his unique thinking system. It was this system that would profoundly influence Buffett, catalyzing his evolution from a pure Graham-style cigar-butt investor into the buyer of wonderful businesses at fair prices that we know today. Principle number 1, build a latticework of mental models. This is the most famous and foundational principle of the Munger philosophy. It is his grand solution to what he considered the most dangerous human tendency, looking at a complex world through a single, narrow lens. To explain this danger, he used a powerful analogy. To a man with only a hammer, every problem looks like a nail. In the context of investing, this means that a professional who is trained in only one discipline will inevitably analyze every investment through the distorted filter of that single discipline. An accountant will see a company as a collection of financial statements. An economist will see it as a function of macroeconomic variables. A marketing expert will see it only in terms of its brand power. Each of them, while being an expert in their own field, is operating with a form of intellectual blindness. They are seeing only a small part of a much larger, multifaceted reality, and this narrow view leads to profound and often catastrophic errors in judgment. Munger's solution was to develop what he called a latticework of mental models. A mental model is a big idea from a major, time-tested academic discipline. It is a representation of how that discipline understands the world, a powerful tool for thinking. His argument was that to be a truly rational thinker, one must learn the big ideas from all the important fields: mathematics, physics, biology, engineering, psychology, history, and so on. The goal is not to become an expert in every field, but to learn the fundamental models well enough to use them as analytical tools. The lattice work part of the phrase is equally important. It is not enough to simply collect a list of isolated models. The models must be interconnected, hanging together in a cohesive framework where the ideas from one field can interact with and reinforce the ideas from another. Let's deconstruct some of his most cited models to understand how this works in practice. From physics, he would borrow the concept of equilibrium. He understood that economic systems, like physical systems, tend toward a state of balance, but he was more interested in the concept of breakpoints. The idea that a system can absorb pressure for a long time before suddenly reaching a critical point and changing its state completely. This is the intellectual model for understanding market crashes and sudden industry disruptions. From engineering, he borrowed the concepts of redundancy and margin of safety. Just as an engineer builds a bridge with far more supporting capacity than is needed for a normal day, an investor must only buy a security when its price provides a significant buffer below its calculated intrinsic value. This margin of safety is the redundancy that protects against errors, bad luck, and unforeseen events. From biology, he drew powerful analogies. He viewed the economy as a complex ecosystem. He used the model of evolution and natural selection to understand how businesses compete, adapt, and die. A company with a wide moat, his famous term for a durable competitive advantage, is like a dominant species in a stable ecosystem. A disruptive new technology is like the arrival of a new, more effective predator that can cause the extinction of even the most established incumbents. This biological lens allowed him to think about a company's long-term competitive durability in a way that a simple financial analysis could not. The most important discipline in his lattice work, however, was psychology. He believed that a basic understanding of the standard cognitive biases was the most essential tool for any investor. Models like operant conditioning from behavioral psychology helped him understand how incentives drive human behavior. He famously stated, "Show me the incentive and I will show you the outcome." This single model is a powerful tool for analyzing the motivations of a company's management, its auditors, and the Wall Street analysts who cover it. By building this rich, multidisciplinary lattice work, Munger was able to analyze an investment opportunity from multiple angles. When he looked at a company like Coca-Cola, he didn't just see a balance sheet. He saw a psychological phenomenon built on classical conditioning, the brand's association with happiness. He saw a logistical marvel in its distribution system, an engineering model. And he saw its market position as a dominant, almost unkillable species in the global beverage ecosystem, a biological model. This holistic view, made possible by his lattice work of mental models, was the source of his profound analytical edge. Principle number 2, invert, always invert. If the lattice work of mental models is the toolkit for understanding a problem, inversion is Munger's primary method for solving it. This principle is borrowed from the great German mathematician Carl Jacobi, who believed that many difficult problems were best solved by thinking about them backward. Munger's version of this is simple and powerful. Invert, always invert. Instead of asking the direct forward-looking question, he would turn it on its head and analyze the opposite. He found that by identifying and rigorously avoiding all the paths to a negative outcome, one is often left with the clear path to a positive one. In life, instead of asking, "How can I be happy?" Munger would ask, "What are all the things that would guarantee I would be miserable?" This leads to clear answers, fall into envy, resentment, debt, and substance abuse. By simply avoiding these obvious causes of misery, one has a much higher probability of living a happy and successful life. He applied this same powerful technique to investing. Instead of asking, "What makes a great investment?" Munger would start by asking, "What makes a terrible investment?" This immediately generates a clear checklist of things to avoid at all costs. A business with a terrible economic model, like a pre-regulation airline, a company that is massively over-leveraged with debt, a management team that is demonstrably dishonest or incompetent, a business operating in a rapidly dying industry, an enterprise that is far outside your own circle of competence, and of course a stock trading at a ludicrously high price. By systematically screening out all of these paths to guaranteed failure, the remaining universe of potential investments is of a much higher quality. He also used inversion to analyze the durability of a company's competitive advantage. Instead of asking, how can this company continue to succeed? He would ask the more powerful question, what could kill this company? This forces a focus on the most critical risks. What new technology could make its product obsolete? What new competitor could erode its market share? What change in regulation could destroy its profitability? What mistake could a new CEO make that would ruin its brand? By thinking through all the potential modes of failure, he could gain a much deeper appreciation for the true strength and resilience of a company's moat. Inversion is a simple but profound tool for cutting through complexity and clarifying the true risks of any decision. It is a powerful antidote to the natural human tendency of optimistic overconfidence. For Munger, the first step to being brilliant is to consistently avoid being stupid, and inversion is the primary tool for achieving that goal. Principle number 3. Master the psychology of human misjudgment. This principle is the logical extension of the first two and is the absolute core of Munger's defensive philosophy. He believes that the single greatest advantage an investor can have is not a higher IQ or a better financial model, but a deep and practical understanding of the standard cognitive biases that cause intelligent people to make irrational decisions. His legendary 1995 speech, The Psychology of Human Misjudgment, which we will explore in greater detail in the second part of this analysis, is a masterclass on this topic. His core argument is that the human brain did not evolve to operate in the complex, abstract, and high-stakes environment of the modern financial markets. Our minds are running on ancient software full of glitches and shortcuts that, while useful for survival on the savannah, are disastrous when applied to investing. Munger's goal was to learn, catalog, and understand these biases so he could recognize them in others and, more importantly, defend against them in himself. While his full list contains 25 biases, we will introduce 3 of the most powerful ones here to illustrate the concept. The first, and the one he considers most important, is incentive-caused bias. He famously stated, I think I've been in the top 5% of my age cohort all my life in understanding the power of incentives, and yet I've always underestimated it. The principle is that people will almost always act in their own self-interest, and their behavior can be reliably predicted by understanding their incentive structures. This is his primary tool for analyzing the actions of corporate management, auditors, and Wall Street analysts. If a CEO's bonus is tied to short-term earnings per share, they will be heavily incentivized to pursue short-term gains, even at the expense of long-term value. If an investment bank gets a huge fee for completing a merger, they will be incentivized to recommend that merger, regardless of whether it is a good business decision for the shareholders. Understanding the incentives at play, Munger argued, is the key to cutting through the noise and understanding the true motivations behind any corporate action. The second is the bias from social proof. This is the powerful human tendency to think and act like those around us, especially in situations of uncertainty. In the market, this manifests as herd behavior. People feel psychologically safe buying a stock when its price is high and everyone else is buying it, because the actions of the crowd provide proof that it is a good decision. Conversely, they feel terrified to buy a stock when its price has collapsed and everyone else is selling, even though that is logically the point of maximum opportunity. Munger understood that this instinct is a direct path to buying high and selling low. His entire lone wolf approach to investing is a conscious and deliberate defense against the powerful pull of social proof. A third is the liking and loving tendency. This is the bias to ignore the faults of people or things we admire. In investing, this can manifest as a dangerous attachment to a charismatic CEO, or a love for a company with a compelling story or a popular product. An investor might fall in love with a company like Tesla because they admire its visionary leader and its revolutionary products. This emotional attachment can then blind them to very real risks, such as its high valuation or intense competition. Munger taught that an investor must be a clinical, detached analyst, capable of dispassionately assessing the facts of a business, regardless of their personal feelings about its products or its leader. Munger believes that understanding these psychological biases is the most important skill an investor can have. Which cognitive bias do you see most often in yourself or in the market today? Share your observations in the comments. These three foundational principles, building a latticework of mental models to see reality clearly, using inversion to solve problems effectively, and mastering an understanding of human psychology to avoid self-sabotage, form the complete intellectual operating system of the Munger mind. In the next part, we will explore how he applies this powerful system to the practical world of investing, detailing his specific doctrines for selecting businesses and managing a portfolio for long-term wealth. In the first part of our analysis, we deconstructed the intellectual operating system of the Munger mind. We explored the three foundational principles that govern his entire approach to reality: the necessity of building a multidisciplinary latticework of mental models to see the world as it truly is, the powerful problem-solving technique of inversion, which seeks to avoid failure rather than to chase success, and the profound importance of mastering the psychology of human misjudgment to protect oneself from the universal follies of the human brain. This is the thinking system, the software that runs in the background of his every decision. Now, we transition from the abstract architecture of his mind to the concrete, practical application of that system in the high-stakes world of investing. This second part is a deep dive into the four specific doctrines that guided his actions as a capital allocator. These are the rules that translated his worldly wisdom into worldly wealth. We will explore his strict criteria for selecting businesses, his radical philosophy on portfolio management and patience, his uncompromising insistence on intellectual honesty, and the simple, practical tool he used to bring all these ideas together. This is the Munger investment doctrine. Principle number 4. Invest only in businesses with wide, durable moats. This is the central investment criterion of the mature Munger and Buffett philosophy, the principle that marked their definitive break from the purely quantitative, cigar-butt investing of Benjamin Graham. Munger understood that the greatest long-term fortunes were not made by buying mediocre businesses at cheap prices, but by buying truly superior businesses at fair prices. His entire analytical process was therefore geared towards identifying this elite group of companies. To do so, he used the powerful metaphor of a moat. He viewed a great business as a strong castle, and the company's sustainable competitive advantage as the wide, alligator-filled moat that protects that castle from invaders. The wider and more durable the moat, the safer the castle, and the more valuable the business. Munger identified several distinct types of economic moats. The first is intangible assets. This includes powerful, world-renowned brands such as Coca-Cola. A brand is a moat because it creates a share of mind with consumers, allowing the company to charge a premium price and command loyalty that is difficult for a competitor to replicate. This category also includes patents, which provide a temporary legal monopoly, and regulatory licenses, which can create high barriers to entry for new competitors. The second type of moat is switching costs. This is the pain, expense, or inconvenience a customer would have to endure to switch from the company's product or service to a competitor's. A company whose software is deeply integrated into the daily operations of its clients, for example, has a powerful moat because the cost and risk of switching to a new system are immense. This locks in customers and creates a stream of predictable, recurring revenue. The third, and one of the most powerful moats, is the network effect. This occurs when a product or service becomes more valuable as more people use it. A credit card company like American Express is a classic example. The more merchants that accept the card, the more valuable it is to cardholders, and the more cardholders there are, the more essential it is for merchants to accept it. This creates a powerful, self-reinforcing feedback loop that locks out competitors and allows the dominant network to thrive. The final major type of moat is a cost advantage. This is the ability of a company to produce its goods or services at a consistently lower cost than its rivals. This can come from immense economies of scale, from proprietary, more efficient processes, or from a unique geographic advantage. This cost advantage allows the company to either undercut its competitors on price or to earn higher profit margins, creating a durable competitive edge. For Munger, the word durable was the most important part of this analysis. He was not interested in a temporary advantage. He was looking for structural advantages that were likely to last for decades. This focus on long-term predictability was the key to his approach. He was not trying to guess which new technology would win. He was trying to identify the castles with the widest and most unbreachable moats, knowing that these were the businesses that would compound wealth for a lifetime. Principle number 5, practice. Sit on your ass investing. This principle, articulated with Munger's characteristic bluntness, is his philosophy on portfolio management, and it stands in stark opposition to the hyperactive culture of Wall Street. It is a doctrine of extreme patience and profound concentration. Munger believed that the modern financial industry, with its constant chatter, its obsession with quarterly performance, and its glorification of action, was a machine designed to produce mediocre results for its clients. His approach was the complete opposite. The first component is patience. Munger understood that truly great, once-in-a-lifetime investment opportunities are exceptionally rare. They do not appear every day or every month or even every year. He believed that the single greatest mistake an investor can make is feeling the need to be constantly busy, to always be buying or selling something. This activity bias leads to buying mediocre companies at fair prices, simply for the sake of being invested. Munger's approach was to do the exhaustive, multidisciplinary research required by his other principles, and then to wait. He was willing to wait patiently, sometimes for years, holding large amounts of cash until the perfect opportunity presented itself. What Warren Buffett famously calls the fat pitch, the one easy, obvious swing that promises a home run. He once said, "It's waiting that helps you as an investor, and a lot of people just can't stand to wait. If you didn't get the deferred gratification gene, you've got to work very hard to overcome that." The second component of this principle is concentration. Munger was a fierce critic of the conventional wisdom of broad diversification, which he often derisively called diversification. He argued that for a knowledgeable investor who has done their homework, owning 100 different stocks is a profound mistake. It is an admission that one does not have a high degree of conviction in any single one of them. His approach was to find a mere handful of truly outstanding businesses, the ones with the wide, durable moats, and to make very large, concentrated bets on them. He stated, "The game of investing is about a few great opportunities, safely recognized. The whole secret of the game is to play it only when the odds are heavily in your favor." He believed that owning a concentrated portfolio of 3 or 4 wonderful, well-understood businesses was far safer than owning a diversified portfolio of 50 mediocre or poorly understood ones. The deep knowledge of those few businesses was his true form of risk management. This entire philosophy is underpinned by another of his famous concepts, the too hard pile. Munger believed that the vast majority of businesses and investment opportunities were simply too complex, too unpredictable, or too far outside his circle of competence to analyze with any degree of certainty. The key to his success was his intellectual humility. He was brilliant at quickly identifying these too hard situations and immediately throwing them into a mental discard pile freeing up his mental energy to focus only on the rare, simple, and obvious opportunities where he had a clear, demonstrable edge. Principle number 6, know your circle of competence. This principle, which he shares and often discussed with Warren Buffett, is the bedrock of his commitment to intellectual honesty. The idea is simple, but its application is profound. Every investor, through their unique experiences, education, and interests, develops a deep understanding of certain industries and business models. This area of deep specialized knowledge is their circle of competence. Outside of this circle lies the vast universe of businesses and investments that they do not fully understand. The single most important rule for Munger is to never, under any circumstances, stray outside of that circle. He famously stated, "It's not about how big your circle is. The important thing is staying inside the circle." This is a radical statement of intellectual humility. The goal is not to be a universal expert who has an opinion on every stock and every market trend. The goal is to be brutally honest with yourself about the limits of your own knowledge. Munger believed that the greatest and most catastrophic investment mistakes are not made when an investor buys a mediocre company within their circle of competence. They are made when a brilliant investor buys a seemingly great company that operates in a field they do not truly understand. They are making a bet without a real edge and are therefore simply gambling. The most famous practical application of this principle was Munger and Buffett's decision to completely avoid the technology bubble of the late 1990s. While the rest of the world was caught in a euphoric frenzy over internet stocks, and while they were being heavily criticized by the financial press for being out of touch, they did nothing. Their refusal to participate was not because they predicted the crash with certainty. It was the simple and honest admission that the long-term competitive dynamics, the business models, and the valuations of these technology companies were far outside their circle of competence. They did not understand how to tell which of the hundreds of competing dot-com companies would have a durable competitive advantage in 10 or 20 years. And because they could not understand them, they did not play. This discipline protected them from the catastrophic industry-wide collapse that followed, a collapse that wiped out many of the so-called new paradigm investors. This principle is a powerful defense against the psychological bias of envy and the fear of missing out. It is the discipline of saying, "I don't know," 3 of the most important words in an investor's vocabulary. Principle number 7, use checklists to avoid folly. This is Munger's final practical tool for bringing his entire philosophical framework to bear on a specific investment decision. It is his primary defense against the very psychological biases that he so brilliantly cataloged. Munger was heavily influenced by the use of checklists in other high-stakes professions, most notably aviation. He reasoned that if an experienced airline pilot who has flown thousands of times must use a checklist before every single flight to prevent simple, catastrophic errors caused by oversight, stress, or complacency, then an investor who operates in an equally complex and unforgiving environment should do the same. For Munger, a checklist is not a tool for finding brilliant ideas. It is a defensive tool designed to prevent stupid, unforced errors. It is a systematic way to ensure that all the core principles of his philosophy are considered before any capital is committed. While his exact personal checklist is private, one can construct a Munger-style checklist based on his public statements and writings. It would include a series of critical questions. From the world of inversion, have I thought about all the ways this investment can fail? What could destroy this business? From the world of psychology, am I being influenced by social proof, overconfidence, envy, or the liking tendency? Are the company's managers being driven by sound business logic or by incentive-caused bias? From the world of business analysis, does this business have a wide, durable, and understandable moat? Does it have a history of high returns on capital? Is the management team both talented and honest? And from the world of self-awareness, is this business squarely within my own circle of competence? Am I buying it at a price that provides a significant margin of safety? The purpose of this checklist is to force a slow, deliberate, and rational decision-making process. It acts as a circuit breaker against the fast, intuitive, and often emotional thinking that leads to the most common investment follies. It is the final practical expression of his entire philosophy. It is the tool that ensures that the wisdom of his latticework of mental models is actually applied when it matters most. The first step in building a successful system is building the habit of disciplined study. The philosophy of Charlie Munger is not an abstract theory. It is a set of principles that requires reinforcement. If you are serious about developing the habits necessary for success, subscribe to this channel and click the notification bell. Let this be the place you come to forge the intellectual framework that will define your future in the markets. In conclusion, the 7 principles of Charlie Munger form a complete and coherent system for rational decision-making. In reviewing them, a clear theme emerges. His genius is not in a single secret formula for picking stocks. His genius lies in his profound understanding that the greatest barrier to investment success is not the complexity of the market, but the inherent flaws and biases of the human mind. His entire philosophy is a brilliantly engineered defense against this internal enemy. His latticework of mental models is a tool for seeing the world objectively. His principle of inversion is a tool for avoiding disaster. His mastery of psychology is a roadmap to the standard follies of human cognition. And his investment doctrines, the search for moats, the practice of patience, the humility of staying within one's circle of competence, and the discipline of a checklist, are the practical weapons for winning this internal war. His legacy is a timeless masterclass in the art of worldly wisdom, a reminder that the key to compounding wealth over the long term is to first master oneself. As a final recommendation for any serious market student, it is valuable to study the raw psychology of speculation, as it is the foundation upon which all market movements are built. The foundational text in this area remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. The main character, Larry Livingston, is the prototype of Jesse Livermore. It is a book that transcends time, offering profound insights into the unchanging nature of markets and men. We highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, making its lessons more powerful and accessible than ever before. A link to this essential edition has been provided for you in the description below.